Walgreens. Once a staple of American communities with over 9,000 stores and $147 billion in annual sales, Walgreens now faces headlines about closures, shrinking profits, and a plunging stock price. In this video, we'll break down the 7 key factors behind Walgreens' decline and what the future might hold. Walgreens' rapid expansion once made them seem unstoppable. In the early 2000s, the company was opening new stores at a breakneck pace, aiming to be within reach of every American household. Their signature red and white signs became a familiar sight, dotting city blocks, suburban corners, and even rural highways. Walgreens was on a mission to outpace its competitors and dominate the pharmacy retail landscape. Stores popped up everywhere, sometimes even across the street from each other. In some neighborhoods, it wasn't unusual to see 2 or even 3 Walgreens within a few blocks, each vying for the same pool of customers. This aggressive approach was meant to capture market share, but it also led to confusion and redundancy. But this aggressive growth led to oversaturation, cannibalizing sales and straining resources. Instead of drawing in new shoppers, many locations simply split the existing customer base, causing individual stores to underperform. The company's resources, staff, inventory, and marketing were stretched thin, making it harder to maintain high standards across the board. Many new locations were poorly chosen, hurting profitability. Some stores opened in areas with little foot traffic or in markets already saturated with competitors. These missteps meant that certain stores struggled from day one, never reaching the sales figures needed to justify their existence. The costs of acquiring and integrating so many stores quickly added up. Real estate expenses, renovation costs, and the logistical challenges of merging new locations into the Walgreens system all took a toll on the company's bottom line. The initial excitement of expansion soon gave way to the harsh reality of mounting bills and diminishing returns. Margins shrank, and the returns didn't justify the breakneck expansion. As profits fell, Walgreens was forced to make tough decisions, cutting hours, reducing staff, and even closing underperforming stores. The dream of endless growth was replaced by the need for damage control. Instead of strategic placement, Walgreens chased numbers, missing the bigger picture. The focus shifted from building strong, sustainable stores to simply increasing the store count. This short-sighted strategy ignored the importance of understanding local markets and customer needs. The cycle of opening more stores to maintain growth only deepened the problem. Each new location was supposed to boost revenue, but instead it often siphoned sales from existing stores, creating a vicious cycle of diminishing returns. It's a classic case of growth for growth's sake backfiring. The relentless pursuit of expansion blinded Walgreens to the warning signs: empty aisles, declining sales, and frustrated employees left to manage struggling stores. Sustainable success requires careful planning and market understanding, something Walgreens lost sight of. True growth comes from knowing your customers, choosing locations wisely, and building a loyal base, not just adding more stores to a map. Their expansion frenzy became a cautionary tale for the entire retail industry. Other companies watched as Walgreens struggled, learning that unchecked growth can quickly turn from an asset into a liability. The lesson: bigger isn't always better. Sometimes focusing on quality over quantity and understanding the unique needs of each community is the real key to lasting success. Walgreens' pharmacy business was once its crown jewel, the heart of its operations and the main driver of its reputation as a trusted neighborhood health destination. For decades, customers relied on Walgreens not just for prescriptions, but for expert advice and a sense of community care. The familiar red sign was a symbol of reliability, and the pharmacy counter was always bustling with activity. But in recent years, the landscape has shifted dramatically. Online competitors like Amazon Pharmacy and PillPack have entered the market, fundamentally changing how people access their medications. These digital disruptors offer the convenience of home delivery, often at lower prices, and have made it easier than ever for customers to manage their prescriptions with just a few clicks. The traditional model of picking up medication in person is no longer the only option, and Walgreens has felt the impact. At the same time, the rise of generic drugs has further squeezed profit margins. While generics have made medications more affordable for consumers, they have also reduced the revenue that pharmacies like Walgreens can earn from each prescription. The competition to offer the lowest price is fierce, and every dollar counts. Adding to the pressure, pharmacy benefit managers, or PBMs, have slashed reimbursement rates for pharmacies. These middlemen negotiate prices between drug manufacturers, insurers, and pharmacies, and their aggressive cost-cutting has made it increasingly difficult for Walgreens to profit from filling prescriptions. The paperwork and negotiations are endless, and the financial rewards are shrinking. The result? The pharmacy, once a reliable cash cow, is no longer the steady source of income it used to be. Empty counters and shorter lines are becoming more common, and the sense of security that once came from the pharmacy business is fading. In response, Walgreens has tried to adapt. The company has invested in telehealth services, allowing customers to consult with healthcare professionals remotely. It has also expanded its range of digital health offerings, from online prescription management to virtual wellness visits. These innovations are promising, but their long-term impact on the bottom line remains uncertain. The pharmacy landscape is evolving at a breakneck pace. New technologies, changing consumer expectations, and fierce competition mean that Walgreens must continue to innovate just to keep up. The company is experimenting with new healthcare services, updating its stores, and rethinking its approach to customer care. But competing on price and convenience is tougher than ever. Customers are more informed, more price-sensitive, and have more choices than at any point in history. Walgreens must find ways to stand out, whether through superior service, unique offerings, or a renewed focus on community health. The challenge is clear. Walgreens needs a bold new strategy to reclaim its edge in the pharmacy business. The path forward will require creativity, investment, and a willingness to embrace change. Only by reimagining its role in the healthcare ecosystem can Walgreens hope to thrive in this new era. Walgreens' retail side isn't faring much better. Inflation and rising costs have squeezed profits across the board. Competition from Walmart, Target, and Amazon is fiercer than ever. As prescription sales drop, so does foot traffic, hurting impulse buys and overall sales. Attempts to revamp private labels and add fresh food have mostly flopped. Walgreens is stuck between declining relevance and relentless competition. To survive, they need to stand out in a crowded market. The old formula isn't working anymore. Reinvention is no longer optional, it's essential. In recent years, Walgreens found itself at a crossroads. Facing mounting challenges in its traditional retail pharmacy business, the company knew it needed to adapt or risk falling behind. To offset these struggles, Walgreens decided to make a bold move. It bet big on healthcare, hoping to transform its identity and future. Walgreens poured billions of dollars into a sweeping vision. They invested heavily in primary care clinics, specialty pharmacies, and cutting-edge digital health partnerships. The company partnered with VillageMD to open clinics inside its stores, acquired stakes in specialty pharmacy providers like Shields Health Solutions, and launched digital platforms to connect patients with care more seamlessly than ever before. The goal was ambitious: to become a one-stop health and wellness hub for millions of Americans. Walgreens wanted to be more than just a place to pick up prescriptions. It aimed to offer everything from routine checkups to chronic disease management, all under one roof. But breaking into the complex world of healthcare proved far tougher than expected. The company quickly encountered a maze of regulatory hurdles, operational headaches, and cultural clashes between retail and medical staff. Integration challenges mounted, as did stiff competition from established healthcare giants and rival pharmacies like CVS. Meanwhile, the returns on these massive investments were slow to materialize, putting pressure on Walgreens' bottom line. The anticipated synergies and cost savings that executives had promised simply didn't materialize. Instead, the company found itself grappling with higher costs, operational inefficiencies, and growing skepticism from investors. As a result, Walgreens has been forced to scale back its once grand ambitions, closing clinics and reevaluating its healthcare strategy. This retreat has raised tough questions about the company's overall direction and its ability to compete in a rapidly changing industry. Diversification, as Walgreens learned, is inherently risky. The company's foray into healthcare has been a costly and humbling experience, serving as a stark reminder that even industry giants can stumble when venturing outside their core strengths. Today, Walgreens' healthcare gamble remains unresolved. The company is still searching for the right formula to balance innovation with profitability, and its future in the healthcare space is far from certain. For now, Walgreens' journey stands as a costly lesson in knowing your strengths and the importance of careful strategy when chasing diversification dreams. Walgreens once thrived under stable, family-led leadership, but a revolving door of CEOs has led to strategic confusion and inconsistency. Plans are made, then scrapped, initiatives launched, then abandoned. Employees and investors are left in limbo, unsure of the company's direction. Each new leader brings a different vision, making it hard to build momentum. The constant churn at the top has destabilized the entire organization. Walgreens needs steady leadership to navigate its challenges. Without it, the company risks drifting further off course. Walgreens has faced a wave of lawsuits and settlements, damaging its reputation and finances. High-profile cases like those tied to the opioid crisis have eroded public trust. Accusations of overcharging and improper dispensing have led to costly settlements. These legal troubles have tarnished Walgreens' image as a trusted healthcare provider. The negative headlines make it harder to win back customers. Ethical missteps in healthcare are especially costly. Rebuilding trust will take time and real change. Retail theft is a growing crisis for Walgreens. Organized crime rings target stores, costing billions industry-wide. To fight back, Walgreens has locked up everyday items, frustrating customers and staff. The result? A worse shopping experience and no real solution to theft. Security measures inconvenience everyone but don't stop determined thieves. The problem is complex, with no easy fix. Retailers, law enforcement, and policymakers must work together. For now, it's a lose-lose situation for Walgreens and its customers. The challenge is only growing. Walgreens faces a perfect storm: overexpansion, a struggling pharmacy, failed diversification, and leadership turmoil. Can this American icon turn things around, or is it destined to fade away? Share your thoughts in the comments below. Thanks for watching, and thanks to Kinsta for sponsoring this video.